man, hopefully you guys are all out there shouting, oh man, in whichever room you guys are in. We are 15 or so minutes away from our key interest rate decision. Are we going to get a dovish surprise where we get 75 basis points or lower? Are we going to see that hawkish surprise where we get the 100 basis points surprise, which may upset the markets? We're going to take a look. We're going to stream that. Remember, the information is going to come out in 15 minutes. We're going to see a bit of movement in the market, which we'll monitor. And then half an hour later, we'll stay on the stream in the meantime, looking at the charts. Half an hour later, you will hear Jerome Powell at his press conference being asked certain questions. Hopefully we get a good set of questions and we can see what his opinion is in terms of future projections. And that is what the market's going to want to look at. Now, guys, as you can see here, let's see who we've got, everybody. Let's see who we've got. Billy, good to see you. Looking forward to this. Yep, it's exciting. It's a big step today. Steve is wondering if we'll get 100 basis points. Let's see. Andy Smith's got his popcorn ready. Good to see you, Andy. Steve, Bitcoin is popping off. We'll come on to that in a second. Doug, good to see you. Bring it on. Absolutely. Let's bring it on, guys. Do smash up the like button. 81 of you in here. Please do smash up the like button. It'll mean more people can jump into this live stream and find out this information, which is really important. Good to see you, MK. Here we go. Hollandy, good to see you. Marcos, let's go. Okay. So first thing, why is Bitcoin moving, right? What's going on? Good to see you, Johnny, as well. What's going on with Bitcoin? Well, the first thing we need to understand is, look, this is traders playing games, okay? And we've seen this time and time again. You guys, if you've watched a couple of these with me by now, you understand how this works. Traders will play and manipulate the market in the lead up to the FOMC meeting. So what I've done is I've put the 5-minute chart of Bitcoin on the left-hand side. We've got the 5-minute chart of the S&P here on the right-hand side. And we've got two vertical lines, which I've drawn. The yellow is going to be, the yellow line here is going to be when we get the interest rate decision. Exactly on the hour, and then half an hour later when the press conference starts. So you will get a bunch of manipulation leading up to that point, but I wouldn't stress too much about that. That's not what we need to worry about. What we need to worry about is what happens in the time after that, right? Like, what is the interest rate hike? More importantly, what is going on in terms of the longer term projections? That is what we need to be worrying about and thinking about, because the reality is, getting the rate hike is the first step. And like we said, the market has already priced in, 75% of the market has priced in 75 basis points. So the market is saying, look, Jerome Powell, you're not brave enough. You're not going to do 100 basis points. So that's pretty much the only thing I can think of that's in play that can surprise the markets today. If we get 75 basis points, it'll be all right. Maybe a bit of red, bit of green, bit of sideways, nothing too major. I'm not expecting a crazy rally at 75 basis points. It's already priced into the market. If we see that 100 basis point surprise, that is where things can get really interesting for the markets, because they're not expecting that. They've not priced that in. They actually did price it in at one point earlier in the month, and then they've unwound it, okay? So that's where we saw that rally in Bitcoin and the markets, where they unwound it. They said, Jerome Powell's not going to do 100 basis points. He's not going to do it, okay? So a lot to look out for. Remember, we get a GDP figure tomorrow. So this, in context with that, is our data we need. And what we've seen in previous FOMC meetings we've seen a bit of a rally when Jerome Powell speaks. We've seen a rally at the interest rate hike, a good day like today, but then the next 2, 3, 5, 6 days after is just a slow bleed back down into the channel. And that's what we want to keep an eye out on here. If I bring this chart back up, which gives you a good idea of what happens every time we have CPI and inflation, you've seen what's happened, right? We get a consolidation, and then after that, we just fall. Consolidation, fall. So don't get caught up if we have a bit of a run. Don't get excited. We could be thrown back down to the downside. Let it take its time and let the market digest what is going on. What time are they released? They'll be released in 12 minutes. So I will be pulling up the PDF to see what is the decision. Remember, the 75 basis points takes you to 2.25 to 2.5% on the Fed funds rate. Now, that is called neutral. And that's really important. What does that mean? Well, neutral, all that means is we're now not in an accommodative environment. All this time when the Fed has been printing and the interest rates have been lower than 2.25, you're considered in an accommodative state. In other words, the Fed is helping the economy, right? It's giving you a leg up. Whereas now, once you get to neutral, they're not even tightening yet. They're just neutral. They're just not helping you, right? So again, they're not giving you a leg up, but they're also not making it difficult for you as well. When they start tightening, then they're actually putting pressure on the growth, on unemployment. So these are all the things we want to hear. Now, other things I'm looking for to listen to as sound bites in the press conference, and we'll talk about this a little bit more after we get the announcement, is I want to hear if there's any conversation around pausing rate hikes? Is there anyone? Is there even a couple of the Fed officials who are starting to disagree with each other? Because up to this point, for them, it's been a smooth run. They sit down, they have their meeting, everybody knows they have to increase interest rates, and then they go, okay, we have to increase it aggressively. So they did 0.25, then they did 0.5, then they did 0.75. And again, if today they do 0.75, it would probably be unanimous. But thereafter, are we seeing any disagreements on what's going to happen next month? Are some people saying, no, we should slow down, or should we hold the interest rate on the next meeting? This is the kind of stuff we want to listen to, okay? So really, really important. Evening, Barney. Good to see you. Sue, thank you for the alpha. You're always welcome, buddy. Hey, mate, can you do VeChain? Not today. We're not doing altcoins today. We're focusing on the wider market and this key interest rate decision. Are you hiring Dalton Moore? You can message me in Discord with what your skills are, and maybe we can find something for you. Have you had a good day, Jazz? Yes, thank you very much. I'm super tired today, actually. Didn't get much rest, and I had a few busy startup meetings this morning, actually, which kept me off my desk, and I knew I had to do all this stuff as well. Thank you for asking. Marcus, let's go. Hello from New York. Real a deal. Get the 100 basis points out of the way. The faster we fall, the faster we go back. This is an important point, and part of the market are feeling this. Okay, they want Jerome Powell to just do it. But remember what Jerome Powell said previously, guys. Please do smash up the like button. 155 of you in here, 10 minutes away from this key decision. Do smash up the likes. Can we at least get 100 likes, guys? If all of you guys just sitting there watching right now, just smash up the like button. I would really appreciate that. And if you change your mind, if the stream goes downhill, you can take off the like, right? You can unlike it. So go ahead and do that. Right, 100 basis points. So yeah, a lot of the market is saying, just get on with it, Jerome Powell. What's your problem? But the reality is the market didn't price it in. And if you see what Jerome Powell was saying at one of his press conferences a couple of weeks back, a month or so ago, he was quite happy that the market started to tighten and do it for him, right? So this time the market hasn't done it for him. The market's only priced in 75 basis points for him. So if he wants to go and do the rest, if he wants to do 100 basis points, he's going to need some cojones to go and do that, right? He's going to have to do that piece himself. So let's see if he has the courage to do that. Shane, good to see you, buddy. Hope you're well. MK, absolutely. We need to make sure that like button is smashed. Wrapped up my final trade this afternoon, Billy, and sitting patiently, wait to start again. Yeah, I think that's a smart idea. Just kind of stay back, let the data come in, sit back and reevaluate, and then go back into the market. Hello, everybody. We ready? We are ready indeed, Rafa. Yo, bravo, me. Good to see you. Who else we got? Michael, rip the band-aid off. Yeah, a lot of people are feeling that way. Hello, Marcelino. Pele, love you, Jazz. Sorry, I'm putting Coinbase. Yeah, don't worry. I hold Coinbase. I'm taking my hits on that. And the annoying thing right now with my Coinbase position, which I know this is not what this stream is about, but with my Coinbase position is like when I've got more cash to allocate, I'm like, I'll just buy Bitcoin instead of Coinbase. Like they're too correlated, right? So you want to be careful in terms of how much you have in your portfolio of these kind of plays because they're very correlated. 22K resistance line still in play. Ijaz, we'll take a look at the key resistance lines very shortly. We'll come on to that. Digital D, hi everyone. Hollandy, be back in 12 minutes. Yeah. Vishal, yo, hope you're doing well. Benj Crisp, oh man, first time live. Well, you made it, Benj. Good stuff. Yusuf, markets can be funny sometimes. If we get a technical recession confirmed tomorrow, do you expect a market dip? Yeah, I am. But remember, the White House are going to start their rhetoric around, oh, it's not a technical recession, right? Our economic bureau of economists need to sit down and define that it's a recession, then it's a recession. It doesn't matter. Once we see that negative quarter tomorrow and the news starts to proliferate that, I think we will see a bit of a dip and a little bit of a resetting, right? Because it becomes real. And that's really important. Now, very important, I nearly forgot. One of the important things we need to understand is if you look at historical markets, if you look at past markets, they have not bottomed. And when I say past markets, whether you look at 1989, whether you look at 2003, whether you look at 2009, you look at 2018, or the COVID crash in 2020, markets do not bottom until the Fed bottoms in their interest rates. Okay, really important. So when the Fed U-turn, so right now it's tightening. When they U-turn, that has always indicated the bottom. So some people argue that no, the markets try to preempt that the Fed might in 1 month or 2 months or 3 months start softening the interest rate hikes, but the evidence doesn't show that. The evidence shows that it waits for them to U-turn, and that is the market bottom. So that's going to be something we want to keep an eye out on as well. Right, as promised, what are these key kind of support and resistance levels? You guys know where we're at by now. If you've been following my regular videos, we are back in our channel, okay? We're in this channel which is a bearish flag pattern. Remember, we got the breakout. We've just been thrown back inside. So that's all that matters. You're seeing this support coming here from pivot point at 20,500. That was the perfect target from our head and shoulders pattern. Now, next thereafter, pretty much you've got a bit of support at, well, an important support at 20,000, right? That's a psychological level from the previous 2017 bull run high. We've got to hold that. If you lose that, then for me, you're coming down to 18,800. Now, I don't think that's going to happen immediately, but that if you start losing 20,000, that's where your next progression is going to be over a little bit of time. Okay. And if we get to those levels, it's worrying because we got the failed breakout to the upside. So it's more likely you're going to break to the downside if you start playing around with the bottom of the channel here. So I'll be waiting for buying opportunities. If we breach below 20,000, like my nibbles will be getting bigger and bigger in terms of my Bitcoin dollar cost average positions. And that's my main focus right now. If this pumps and runs, like I'm just going to sit back and let it do its thing. I'm not going to chase it. I don't need to dollar cost average. I'm happy with my position. If I wasn't in the market, I would be frantically dollar cost averaging around these prices because for me, not financial advice, these are really good Bitcoin prices, right? Like having been in the market for many cycles, this is a good price. Whether you buy in at 21,000, whether you buy in 22 or 19, in the long run, it doesn't matter. Either your thesis is right that Bitcoin's going to win and become 100K, 200K, 250K, whatever the projections are for you and your conviction levels, or you're wrong, right? So it doesn't matter to you whether you buy in at 19 or 21 for your long-term portfolio. That's the way I think about it. But if we fall below 20 and start heading back into these 19, 18 levels, I really will be buying bigger chunks. And if we lose this level to go test 17,600, then that will get juicy again. And I'll be excited because there's no guarantee we're going to get some of those prices again. But I would love it if we did fall back down to some of these prices. Okay, so that's what we're looking at in terms of the Bitcoin chart. Right, 5 minutes to go. We will be refreshing to see the PDF. Any reds expected between now and the meeting start time? Not sure what you're asking there. You mean like red candles? Yeah. I mean, you do get buy the rumor, sell the news, right? Which is what this would be. Some people get excited and they'll dump in the lead up to the announcement in a couple of minutes. That's what traders do. Canadian boy, thanks for the live. You're always welcome, guys. 211 of you guys in here. Please do smash up the like button, guys. We've only got 90 likes, which I'm not the best at maths, but you know, that's not the best ratio, right? I know I studied maths at uni, but come on, guys. Come on. Hey, dude. Good to see you, Golden Surfer. Bench Chris. Capo could well be right. DCA sub 17. Yeah, so even when we bounce from 17,000 here, you can ask the course members who are on our course member live streams and also on our videos. Like I always never felt confident in any of these pumps. Like even this one here, I said until we close 24, I'm holding that we're going to revisit 17,600. It's just the on-chain metrics were not tying up with the fact that we're ready to rotate, and the macroeconomy definitely was not ready, right? We've not seen inflation come down. We've not seen these kind of things come down. One more thing while I've got a couple of minutes here, I need you guys to remember we still have huge earnings coming, right? So yes, we've got the FOMC right now and the market's going to move on that. But then afterwards, you got Facebook and you got Ford, right? Two big players giving some earnings after the close. So do not neglect that. That's going to help move the markets. And more than just their earnings, this is what I said to you guys. What did I say yesterday? If you're following my videos, it's not just about the earnings. It's about the forward guidance and the outlook they're giving on the economy. That's what the market cares about right now. They don't care what happened in the past. They care about what you're saying is going to happen in the future. And it's the same for today's FOMC meeting. If we get 75 basis points, which the market's cool with, then they're going to move on. They're going to say, what is Jerome Powell saying that gives us a clue for the future meeting? And same for these earnings. What are Facebook saying that gives us a clue for the future meeting? That's why we saw Google and Microsoft miss on earnings and revenue. Both of these companies missed quite hard, right? But they both continued to pump and rally today because they gave decent enough outlook, particularly with Google and their search business. They gave decent enough projection and outlook for the rest of the year, okay? That's what's important here. The market is really focused on that. Guys, thank you so much for smashing up the like button. I really appreciate you guys. Doesn't cost you guys a penny, but it does make a difference to the effort we're doing here to get more people understanding some of these macro elements, right? I think that's one of the things here. Like a lot of people in the stock market community will be covering this kind of stuff off, and they understand how inflation, how recessions move the markets. But for some reason in our crypto community, we feel like we're above this and we don't need to understand how these move the markets. Like that's really important. We need to understand that these are the things that are moving markets, and this is what's affecting our positions and our entry points and our investments ultimately. So really, really important that we understand that. Marcus, thank you so much for smashing up that like button. Nifiz, good to see you. Can we get this big dump over with? Right, 2 minutes to go, guys. Let's keep it on this. Let's also just take a look at here. We won't sync the date range, so I can flexibly move that. They're both on 5-minute charts. So these are 5-minute candles you're looking at here. We can probably turn it over to a minute candle as well shortly, but I think for now 5 minutes is good. And on my other screen, I will get the PDF up with the interest rate hike. So I'm going to keep refreshing that. As soon as I get it, I will be bringing that on screen for you guys so we can take a look at what the interest rate hike is. Okay, so we'll keep a close eye on that. About a minute to go. I'll keep refreshing. Sometimes the website starts crashing, which is always very fun. In the meantime, you can see we're just getting that selling off, guys. Just like I said on the 5-minute candles, just the traders playing games. Buy the rumor, sell the news. Wouldn't panic too much about any of that. And again, even if the market's happy with the news, it'll run, but it's more about what happens over the next couple of days, right? Unless you're short-term trading this, which if you are, make sure you're using the links in the description to BYBIT and BitGet if you're an experienced trader and you like to trade, and that also supports the channel. If you don't want to use them, that is absolutely fine, guys. Right, keep refreshing. Let me not get distracted by the chat. I will keep refreshing so I can get this to you guys as soon as possible. Let's bring this over onto the screen. Right, hopefully you guys can see my screen. Hopefully we've not got an issue there as I refresh. Just refreshing. Still refreshing, guys. They just take a little bit of a while. My clock's gone on the hour now, so it should be any minute now we get this PDF coming up. There we go. There's the PDF. Let's get that downloaded. Let's see what we've got. Committee decided to raise the target range Fed Fund 2.14 to 2.5%. There you go. 75 basis points, guys, as expected. 75 basis point hike. Let's go ahead and put that into the thing there. Let's also get the screen up. Let's take a look at how the markets are responding to this in real time. And as you can see here, we are moving. Okay, green candlestick on Bitcoin. Stock market is unsure. Very interesting. They're moving in opposite directions. Okay, stock market's keeping up. Starting to move now here on the 5-minute chart. Let's put it onto the minute chart just because we're sad like that. And let's see how we're moving. Big pump there on Bitcoin. Bitcoin's moving strongly here on the news. They're happy with the 1 basis point. Let's show you that here. There you go. Big candlestick there on Bitcoin. Stock market moving in the other direction. And whilst you guys take a look at that, let me just flick through the PDF just to make sure there's nothing else. So the increasing 75 basis point hike. Let's also, let me just make sure. Okay, so the committee is strongly committed to retaining inflation to its 2%. Again, the markets expected this, guys. They knew they wouldn't have, anything much more to say here. Undertake open market operations as necessary. Let's just take a look just to make sure there's nothing else we're missing here. Undertake open market operations necessary to maintain the Fed fund rate to 2.25% to 2.5%. Conduct overnight repurchase operations with a minimum rate of 2.5% with an aggregate operation limit of 500 billion. Conduct overnight repurchases. Fine 160 billion. So this is to do with their rolling off the balance sheet, right? So they need to roll off all the purchases month that exceeds this cap of 60 billion. Okay, fine. So here you go. Starting in the calendar month of September, rollover at auction, the amount of principal payments from the Fed holdings of Treasury that exceeds a cap of 60 billion per month. Okay, reinvest into agency mortgage-backed securities the amount of principal paid that exceeds a cap of 17.5. So we're going to get more details on this, no doubt, when he speaks. But again, let's take a look back at the markets, guys. Getting a big move here on the markets. There you go. You can see big minute charts here on Bitcoin. Bitcoin's heading up. It's gone through 22,000 now. SPY is heading towards 397 here. Market's taking to it well, and it's as expected, right? You're not going to get a crazy move. Like, don't get too excited. It was already priced in at 75 basis points. So nothing much too risky. Nothing too surprising there, guys. Do smash up the like button and subscribe. And now the focus moves onto the anticipated press conference. It's all going to come down to the press conference now. We got what we expected. The market had all but priced this in, right? There's a bit of the market which hasn't priced it in, which is why it's moving now. But we've already seen over this week, 75% of the market through the CME futures had already priced in 75 basis points. Bitcoin now sitting at 22,100 here on the news. And again, don't get caught up on this stuff, guys. A lot of volatility, a lot of traders playing moves. Don't think this is, the reflection. The long-term investors take time to ponder decisions. They'll wait for their GDP figures tomorrow, and they're going to make collective decisions over probably early next week is where we start to see, okay, where is the market out with this? Because you would have had all the major earnings this week. Don't forget, guys, we've also got the likes of Amazon, Apple, Roku tomorrow after play, Pfizer and MasterCard open before the open as well. So really, really important. And here you can see just on this chart here, Bitcoin, what it's doing now in its current pump to 22,000 is trying to break that out of the channel again. But again, we've had that breakup before. And if and only if we get past 24,000, are you going to see me getting a little bit excited for a relief rally, right? So I'm not going to get too excited here until we get to 24. Now, by all means, if you guys are experienced traders, you can try trade the range here, but that's not what we're focused on right now. Let's switch back over to the SPY. Let's see, SPY is now moving. Okay, so initially you saw how SPY dumped and then it picked it back up again. I wonder what that was all about. Again, probably just some manipulation or some traders playing some games. Let's see what you guys are thinking in the comments. Are you guys feeling good that Bitcoin is soaring here? How are you guys feeling about it? Doug saying the futures are green. Casey was saying if it was 1%, we were screwed. Yep, luckily we avoided that, guys. We didn't get the 1%, but it's a double-edged sword, right? Because at the same time, the market will be okay because he priced in 75 basis points. But at the same time, the market's like, this guy is such a wuss, right? They're going to be sitting there going, Jerome Powell, you couldn't do it. Right? Why didn't you do it? Why didn't you just get the pain over and done with? Why didn't you rip the Band-Aid off? So you're kind of damned if you do and damned if you don't. So I wouldn't buy too much into some of these moves. I think Mr. Grade is on the same page as me then. Oh man, I wanted 100 points. Oh well. Yeah, exactly. I think a lot of the markets wanted that. So you said Bitcoin about to smash 22. Yep, past 22 now. Just getting a little bit of rejection at 22 here on the minute chart, but no doubt it'll probably push through that. MK Phantom Pumping, Yusuf, where can we see stock prices after hours? Trading View basic account only shows during trading hours. You can do so using Yahoo Finance. But I don't think, Yahoo Finance. Uni sending, FTM moving nice up, check major alts. I mean, there's not much interest in checking alts unless you guys are trading it, but obviously you're going to get the key alts moving. Ethereum up 6.5%, Phantom up 3.6%, but it's Bitcoin we need to focus on, right? You're getting Matic back up 7%. They're just going to respond accordingly, but we need to know when are we getting out of this mess, right? And that's what we need to understand. How long will the pump last? Up to the press conference. It's going to kind of do this little volatility up to the press conference. Jerome Powell will speak, and then it's going to move on his word, right? Like, what's he going to say? And again, don't be surprised if you see a little bit of run while he speaks, as long as he doesn't say anything silly. And that's what we're going to be looking for. Fazil says Bitcoin to 30K. Not convinced, mate. Dumping back down, says Yusuf. How do you look into fine? Realer Deal says fake out. He's really did is also looking at ApeCoin. Yeah, not something I'm looking at right now. I don't like that wick on the 1 hourly, says Casey. Cool. So, okay, that's what we've got. And the markets are responding to it, as we can see right now. And now we need to focus on, what is going on? What is he going to say? Will they come out and say, okay, we're doing 75 basis points again, but the next meeting, majority of people are now saying 50, and to slow it down. I think things like that, if he says anything like that or comes across dovish and say, look, or tries to play the scenario down, would be positive. Don't forget, he'll get asked about recession as well. I think that's going to be one of the killer questions, which is going to be really important. So we're just looking for clues of, is he going to U-turn? Is he going to go from 75 basis points to maybe loosening it to 50 basis points in the next meeting, or maybe even holding the rate for a little bit? These are the kind of things we want to listen out for now in the press conference. And the press conference normally has more weight than the original interest rate decision, because the market already, to all intents and purposes, know these original interest rate decisions, okay? Casey says, might be a momentum swing, plus it needs to call off. Guys, don't forget, smash up the like button. 243 of you guys in here. Do smash up the like button. We're going to be with you guys streaming this live till the press conference and covering off exactly how this impacts the markets and what we need to look out for. Just, guys, as a bit of analysis, let's just go back over to this chart here. And I want to spend some time looking at this chart. So this is trying to move now, which is interesting. But again, until you create a higher high, you can't get too excited. The good news is you have your higher low, right? So if you're analyzing this from a technical perspective, you're going, okay, I've got my low here and I've got my higher low. But it's irrelevant if you go and do this, right? Because if you do this and you don't create your higher high, all you've done is you've created a head and shoulders pattern. Yeah? So that's what I want you guys to watch out for. And I'm calling it now. Look how early I'm calling that. That's what I want you guys to be very aware of, is if we see a run over the next kind of set of hours and days here, if we see that and we can't go past 24, you're just creating a head and shoulders pattern / double top pattern, right? Even if you hit 24 exactly, if you go 24 exactly and you can't break it, that's a double pattern with this blue line, right? It's an M pattern or a double top pattern. So these are the things I want to look out for. I'm not getting too excited until we get past 24. And as you can see, historically here, the previous meetings were pretty much just as expected as these ones, right? Not many of these were surprises. The market kind of expected these. So even though the market expected them, we fell. So are we going to see that fall after the next couple of days? Again, just to remind you guys here on the hourly, what happened when these rates were, on these days here, when the interest rates, you see that initial move to the upside. Look at this volatility. Then you fall down. Then you go for a run. Then you fall down. So just stay calm out there. Don't trade too crazily if you're not experienced. And if you know what you're doing, then by all means, go ahead and trade till your heart is content. Okay, give me your thoughts, guys, in the comments. What are you thinking about this? What are you expecting from the press conference? And more importantly, are you happy with the 75 basis point hike? Did you want to see a full percentage, or how do you feel about that? Let me guys know. Yes, appreciate your content, mate. Appreciate you, buddy. Thank you so much for being part of the community. Waiting until tomorrow to let the market digest to decide on buying. I think that's clever leftist. I think that's a smart, wise move, particularly if you're talking about the long-term part of your portfolio. Like, there's no point making rash decisions, right? If you're trading, go have some fun, trade with a little bit of lunch money, like I like to say, right? Just some people's lunch money is clearly more than others. Sold Rune at 230 says Golden Surfer. Will this a bigger moving event compared to the GDP figure and potential recession? It's difficult to say. I think the recession, the news tomorrow will probably be bigger, but I think it's more the concoction of all of this stuff. I think that's what's going to be important over the next kind of, let's call it by Monday, Tuesday. So we're going to get we're getting bombarded with data, guys. Please understand, the market hasn't had chance to, from a long-term perspective, digest it. Traders digest it and they trade, but the big funds who are going to allocate positions, they haven't had a chance to digest this all. So you've got a whole bunch of companies' earnings coming out. Alphabet, we had Alphabet, we had Microsoft. You've then got Meta today. You've got MasterCard. You've got Apple. You've got Roku. You then had your FOMC meeting. You're going to have the press conference, which you're going to cover shortly in 20 minutes time here. And then after, you get your GDP figure tomorrow. Like, there's loads to digest. So wait till Monday, Tuesday, and you're going to get a better idea of direction of the market and how they're feeling. And that's what's going to be important for us. So that's what we need to be looking for. Do you think we have reached bottom or more bleed? I still feel like there's a little bit more to go, to be perfectly frank. I still feel like we could potentially see another quick, like, double dip back down to 17,600, but I don't think it'll last. I don't think we're far off, right? Like, if you were to ask me, are we closer to the bottom than we are the top? Absolutely. Like, the analogy I use is, if it's an elastic band, we've pulled it all the way back, right? And all that's happened is someone's pulled it back a bit more and then come back, loosen it. And I think we can just go back tight again before we get ready to go for our bull run. I think that's what could happen, is one more dip down to 17,000. Get that final bit of capitulation. Maybe max the kind of level I'm looking at is about 15,000. I'd be very lucky if I got to buy some more at 15,000. I mean, that would be lovely. But other than that, those are the levels I'm looking at. And from an upside, I can't give you any reason to give you more upside than 30K on Bitcoin right now. And 30K is assuming a relief rally into resistance. Okay, so those are the pragmatic levels I'm looking at right now. Now, obviously, my long-term position, I'm in the market. I'm heavily in the market. I'm waiting for this reversal. I'm dollar cost averaging in prudently as and when I can. And that's where I'm at right now. If the market runs right now, great, right? I wish I want more, but I'm always going to feel like that. I'm always going to feel like I want more in the markets. That's just how things go. Tomorrow will be the recession. Hey, good to see you. Thank you for taking the time to stream and bring us this content. Appreciate you, Vicky. You are always welcome. Fazil, wait until the end of this year. Make vids about your alts in the next bull run. Yusuf, is there any way we can see the press conference, or do we have to wait for the news reports? I'm going to stream the press conference live here in 15 minutes. So we're staying here. We're going to cover it off. I'm going to play it. We're going to go to Jerome Powell, listen to the Q&A together, watch the markets at the same time. So get yourself a drink. I've got myself some water. And we'll cover that off together. Next bull run, not anywhere near. Yeah, it's not near, right? And that's the other point I'm making, is like, a lot of people seem to think, particularly people who are new into crypto, they think we're just going to, you know what? Like this. And by the way, I've drawn all this graph out with all the previous runs, and I want to show you this because it's important. They think suddenly we're just going to rotate from here and just run to the moon. Like, it doesn't work like that. If you look at when we ran to our high of 20,000 in December 17, it took us 12 12 months to fall to our lowest point, which was an 85% retracement, which we haven't had yet, 85%, which is why one of the reasons I think we can see that another pull down. Then we kind of sat there for another 12 months across. And in that 12 months, at summertime, in the middle here, you had a run up back to about, call it back halfway, right? Between the peak and the low. So it ran up halfway. So that's the equivalent of us kind of running back to like 45, 50, and then it came back down again, right? So you're talking 12 months plus another bit, and that was your bottom right there. So if you're calling the bottom on this run, it was March. So it took 1 year to fall, 1 year of sideways, 3 months of a bit more, then it bottomed. That was your final capitulation leg. People thought, okay, we're off here, right? Because you had your fake out. They thought we're off, came back down. Ran back up off. Oh, we're off, came back down. This bit was your final capitulation. Okay, let's just get zoomed in here, see if we can get that in there. Final capitulation. Pulled them all out here, this bit here, flushed them all out as you came back down to about the 4,000 mark. Then it went on its tear. Okay, so that's what I want you guys to understand is like, there's no evidence to suggest things are going to get better and we're just going to run up to the moon straight away. On top of that, we're in a very tricky macro landscape. Bitcoin's not navigated a recession before, let alone this could be quite a deep recession. This is an unprecedented style of recession. So we've got to be patient and we've got to be humbled almost to the fact of, how long could we be here for? Are we going to be 6 months here? Are we going to be 12 months here? You've got to be prepared for these instances. Guys, please do smash up the like button. I really appreciate if we can hit 200 likes. That's not normally something we can achieve on this kind of channel, but I'm convinced you guys can get me to 200 likes. So please do hit up the like button if you haven't done so already. All of those, all four of those bottom support points do almost join up if you move your line, mate. Yep, you can tie them all in. Exactly. I mean, but my point is they kind of flush down one more time. So that's what I'm saying. Can we get that dip back down to 17.6? And then our 17.6 can be like this line here, right? That final kind of low, the bottom, as the people like to say. Do I reckon this is the start of the relief rally? Again, I'd call the relief rally once we pass 24, right? Like I said that on the previous, like last week when everybody was getting excited here. I said, we're really nearly there. If we had that daily close above that EMA ribbon at 24, which we nearly had, I would have called a relief rally. I would have been quite long and bullish on a relief rally up to about 27, 28, maybe even 30, hitting resistance on some of the EMA levels. Victor, hey from Spain. Hope you are well. Good to see you. Crypto Box is saying Bitcoin is going to go to 25.5 by the end of today. Good luck with your trade there. If you're in a trade on it, or if you're just saying it, I guess you're just saying it. Patience is the key in this market. Agree. Seems like too many still buying the dip. Yeah, and that's the key. You've still got a lot of people buying the dip, right? And that is one of my, when I look at the on-chain metrics, you're still seeing the shrimps, which are people with a little bit of Bitcoin. They're still buying, right? They're still buying, and they've not given up hope. And remember, the whales want you to give up hope. That's the definition of capitulation. They want to take your crypto, and they want your crypto. They want to transition that crypto from short-term holders, people who came in on Bitcoin since the highs, like from buying in at 69 and these guys, but they're not selling. I've spoken to many people in this community that came in when Bitcoin was 65, 68, 67, 68, and they're still holding, and they're dollar cost averaging. And I don't think the whales like that. The whales aren't comfortable with that. They want you guys to give up the Bitcoin, and then they'll run up. Next FOMC meeting scheduled 21st September. Would you expect a relief in between as stress eases? Again, if there is a relief, it's not going to be based on the FOMC decisions. The relief will come from good company forecasts, and a better macro landscape. So if we see good company earnings, if we see evidence of inflation coming down in the next CPI readings, if we see consumer sentiment holding up pretty well, if we see retail figures showing positive, if we see all these kind of things showing positive things, we could see a relief rally. It's not going to be based on just the FOMC meeting that we're waiting for here. Honestly, could do this for a year, continue to buy blue chips, hoping to purchase some more. Leftists, I know you've been part of this community for a while. You've absolutely got the right mindset. Like that's what you want to do. Like for me, I'm not fussed. If Bitcoin wants to stay like this a year, that is perfect. It gives me more opportunity to buy, because the only people that are fretting this right now are those that have bought in really high and they're really down, or you're really new, you've just bought in now, it's your first investment, and you just really want to be proven right. Those who have been in a couple of bull markets and bear markets, you're happy for it to stay low, because it allows you to accumulate and get more. Because trust me, guys, when the bull market comes, you guys are going to be bored out of your minds. You're going to be sitting there thinking, I wish I bought more, I wish I bought more, I wish I bought more. And it becomes progressively harder to buy more. When you get to 30, mentally it becomes harder to buy more. When it gets to 40, even harder. 50, 60, now you have to fork out more to buy Bitcoin. Like, it's going to be tough. It's going to be really, really tough. So it's all about psychology there. Really important. Please, Jerome, rug America. Truth Teller says, show me the money. Show me the money. Oh, man, glad I'm able to make it to your live stream. We're pleasure to have you here, Nathan. Thank you for being part of the community as always. Ada is my safe play and Coty is my risk reward play. Yeah, Coty is quite risky, smaller market cap, but I also have a little bit. I used to be a BTC shrimp, then I managed to evolve to a macro. Now I'm back to goldfish to whale by 2075. Yeah, and the crazy thing is, guys, like when you look at the number of wallets with more than one Bitcoin, it's climbing because now when you've got Bitcoin at 20,000, more people can actually they have like a dream. They can have ambition of buying a full Bitcoin. So more people are doing it. They're like, oh, I've got 20K sat there. Instead of going and buying that car or going on a fancy holiday or two, they're going and buying themselves a full Bitcoin. Whereas when Bitcoin is at 69, they're like, oh, I can't be bothered. I don't want, like it's just human psychology. I don't want 0.3 of a Bitcoin, right? So they just don't bother investing that. Right, let's get back over to the short-term time frame. Let's see what we got. There you go. You can see we're kind of just trying to run back up to the high. You've got a bit of a bull flag here on the minute. I mean, this is proper scalping stuff going on right now, but we'll just monitor it just to see how we feel here leading up to the press conference. Press conference is in 10 minutes. Been waiting to buy some Avalanche at 10, but can't see it happening. Ethereum is going to rocket, in my opinion. Okay, cool. Let me just make sure that the stream is working for us. They're not live yet. Another 10 minutes to go. We'll make sure we're up for you guys. Hey, Mr. Got Plenty, what are your different sections in your portfolio? Layer 1, Layer 2, Layer 0, GameFi, what percentage do they make up? It changes all the time, right? And that's something I share with our course members. So if you're on our course member live streams, I do share a Google Sheet with my preferred split of holdings in terms of percentage between Layer 1s, Layer 2s. Right now, like I said, I'm really focused on Bitcoin, Ethereum, and Layer 1s, and a bit of Layer 2s in terms of Polygon and a few others. It's in much tinier chunks. And then as a bull market ensues, I'm happy to layer on other narratives as and when, and we'll cover them on the channel, right? Like as and when I feel it's appropriate for GameFi. For my personal opinion, I'll start talking about GameFi when I see it's right for Metaverse, when I see it's right for privacy coins or any other narratives, NFTs. We'll cover that off as and when needed. But right now, I want to make sure like I'm clear that I need to add more Bitcoin, Ethereum, and that's what we're doing right now. Okay. And yes, I understand that means you end up buying in on altcoins a little bit later, but that's a risk I'm willing to take. By the way, another thing which we have to understand is you have got a bunch of politics going on as well. I know we've not spoken about that, but you've obviously got elections coming up, midterms coming up, and that can affect sometimes what Jerome Powell does versus what he wants to do. So we don't know whether he wanted to do a full 100 basis points and whether, Biden has a chat with him, say, come on, we can't do that. I'm not going to be in favor with, a bunch of my high level friends if you do that. So it's a careful balancing act and a bunch of politics as well as ration and logic, right? It's not all just business for these guys, it's politics as well. It's interesting here how you're seeing Bitcoin kind of holding a stronger uptrend. I mean, it could, I'm always looking out for little things like this where you're seeing Bitcoin, for whatever reason, start to diverge away from the S&P. Now, obviously, this is a tiny timescale. We're talking about minute chart here. I'd always just like to see that because normally you see it very, very in tune together. Now, as you can see, guys, the volumes are now dissipating. They're waiting for the press conference now. The traders are chilling out. They made their money in here. That's what the scalpers do, which is why we stay away from this unless we're very experienced. You just sit back and let the dust settle. If you're an experienced trader, you know what you're doing. The links are in the description. Speaking of which, guys, do check out OKX. Links in the description. I spoke about OKX yesterday. Again, not being paid to mention this. There is an affiliate link in the description which supports the channel. But that, if you guys don't, what's so cool about OKX is I found there's a dollar cost average section on there. And I know this is like, it shouldn't be mind blowing, but it is. Like, this is something I do in my stock portfolio all the time, is you can just jump into OKX and I can actually now set, buy this much Bitcoin, buy this much Ethereum, buy this much Phantom, buy this much Solana, and it'll just do it for me weekly, daily. So good. I'm definitely going to be using that a lot more. So if you guys want to consider that, OKX is doing that. And so I'll be moving a lot of my long-term funds across and do my dollar cost averaging in there for sure. Let's see what you guys hodl 100%. Ijaz, appreciate you. Yep, volatility is dying. That's very normal. Exactly my thinking about the midterms. The administration have already redefined a recession. Yeah, it's all games, right? Biden can't be the guy that drove America to recession. That is not, forget everything. That's your legacy as a president, right? Like, his reign would be awful. So from a political perspective, like, they've got a lot to lose here. And, it's not just pure, oh, this is what's good for the markets. We can't be naive to that. This is politics. And this is a good question, Micro. And if when you see the market moving, I always want you to be skeptical, right? I know this because I worked in traditional finance. I sat with these experienced investment bankers, and I know exactly how they take money from retail investors, right? I know exactly how they do it. And they laugh. They will laugh at you while they're doing it, right? These guys are ruthless. These really experienced traders sit there and they'll take your money. They'll take your money on events like this all day long. Casey, slap the like button. If you're here with us, it helps his ability. Yeah, I'd really appreciate that, Casey. Thank you for the reminder there. Guys, do smash the like button. We got 235 off you. We're 7 likes off of 200 likes. 6 minutes away from the press conference. I'm going to be streaming it with you guys. I could be watching some football, but clearly all of us, all 200 odd, 300 odd of you guys in here have nothing better to do, and we're saddos. But that's what we're going to do. We're going to watch the crypto markets. We're going to see what Jerome Powell says and how it moves the markets. And more importantly, I just want to hear, what does he say about recession? He might give us a clue for tomorrow, and the markets might want to look at that. Still, Bitcoin holding up pretty well here, and NASDAQ curling over. NASDAQ is getting, the S&P here is getting a curling over. And Bitcoin is managing to hold up a little bit nicer here at 22,000. Very interesting. Vicky goes, Biden's legacy couldn't get any worse there. This is true. But he thinks it could be better, right? He thinks. $60 in this pump. Congratulations, Tech. Chantel, glad you're here. You guys are always welcome. If you appreciate the content, you've got to hit up the like button, guys. Like, literally, as a small creator, I can commit to making this content for you guys. Like, that's not an issue. Like, I don't live off of YouTube. My funds come from elsewhere, as you guys can obviously guess. Like, this tiny channel, and I only started this to give you guys the proper data, because I sat there frustrated and I watch these other crypto YouTubers and I just cringe, because I know, and I have cousins, I have friends who watch this content, and they come up to me and they'll ask me my opinion because they knew I was a traditional finance. I was trading. I was into all this stuff. I was professionally trained at this stuff. And they were like, am I doing the right thing? And I would say, where did you get that piece of advice from? And they'll show me the YouTube channels, and I just would cringe. Like, it's so bad that there's a couple of 3-4 channels here on YouTube that YouTube want to continue to promote and give them good reach and good engagement, but they're just getting you wrecked at the benefit of themselves. Like, and you guys will know it, right? Because you'll see that there were people last week who were saying Bitcoin's going to go to 48,000 this week. How did that work out for you, right? And then they'll post videos which is completely contradictory. They just care to put you into 100x leverage position. That's all they want to do, because that's where they profit, right? And that's not what this is about. This channel here is about, guys, I know it's not glamorous. This is not glamorous right now, but this is what builds wealth in crypto. Right? Otherwise, why would the whole market pay attention to Jerome Powell if this is not wealth is being created, where the stock market moves on and asset classes move on, right? But those YouTube channels, which you guys are sometimes guilty of watching, and it's kind of like addictive, right? You just watch it for the kind of thrill of watching those channels. They're really messing you up in the mind, because they just show you stuff which is not right. They're not watching the FOMC right now. They couldn't care less. They might tweet something like, oh, look, 75 basis points interest rate. They couldn't explain to you what's going on. They don't know what neutral rate is. They don't know what a hawk is or a dove is. They don't know what GDP is, how to calculate GDP. Like, if you're taking advice from these people, right, I don't know what to say to you guys. Like, literally, and that's the only reason I'm here trying to push this message, is if we can build a community where the focus is around, guys, let's continually learn. This is a new asset class, and we're going to find out over the next 5, 6, 7, 8 years how this asset class moves and how to build long-term wealth in it. The reality is we're not trying to make a quick buck here. Anybody who makes a quick buck can lose it just as quickly. Just ask any lottery winner. How quickly, on average, does a lottery winner lose their money? Very quickly, because they don't know how they got there, right? Whereas if you guys know the tenets of how to build wealth in crypto and you do it slowly and over time, it's going to stand you in really good stead. And that's what we're trying to do here. So do smash that like button for me, guys, if you appreciate that. I'll commit to continuing to make these videos, but the little bits and pieces of sharing content and, retweeting and all these kind of things, you guys have to support me with that. Jump into the Discord, engage. Small things like that make a really big difference, right? It may sound silly to you, like, oh, I'll press the like button, but that's how the game works, right? And that's how those bigger channels are always getting that exposure, because they have these loyal community, whether rightly or wrongly, pushing that. Martin, you were doing a good job, and I did smash the like button. Martin, you're a legend. Appreciate you. If we can all be like Martin in this community, we'd be in a good place. Somebody said bait boy. That's a good one. I like that. I've not heard that one before. Guys, it's not going to cost you to tap the like button. Agree, Mahmood. Appreciate you. Do smash up that like button. But enough about that. We need to. There's worse than BitBoy, guys. Like, honestly, I'm not going to back Bitcoin, but trust me, there's worse out there than BitBoy. That would be different. Ijaz, your integrity is outstanding. We need more YouTubers with your philosophy. Ijaz, you're a unique guy. You're a unique guy in this game. Keep your platform fact-based and stay the course. The crypto world needs you. I'm not going to change the course. Like, literally, if this YouTube channel doesn't grow because I'm streaming the FOMC meeting, so be it. Right? I can show you a certain car or a certain watch and more people will watch it, but that's not what we're here for. That's not why I started this content. Like, I don't need to do that stuff. Yes, I want to build a community. Yes, I want this channel to be a profitable community where you guys build wealth and the channel self-sustains itself and means I can make videos for you guys. But that's not going to be at the cost of you guys. You guys, like, the key is you guys got to be learning and being right. Come on, you fed. What's the time? 1 minute left. Okay, we'll give him a minute. Yeah, so that's the point, guys. It costs to unlike, but free to like. Yeah, exactly. Someone says, I like that you're online while banter isn't. Forget, yeah. Who's on, like, it's my point. Like, and I want you guys to be open and transparent with it. Like, who's online right now? Right? Who's walking through this content with you? Because when Luna crashes, it's easy to make a video where it's like, I just lost $2 million in Luna, right? Because you know you're going to get the clicks. You might not even hold Luna, but you're making that video. How do people know? Right? But why aren't you walking people through actually how to invest? Why aren't you teaching them how to build their portfolio? Why aren't you teaching them psychology elements of trading? Why aren't you telling them when not to trade? Right? I would tell you guys, how did I start this stream? I said, guys, unless you're very experienced, do not be trading this volatility. Yeah. Now, if you guys click my affiliate links and start trading, like, wouldn't that be beneficial to me? But it's irrelevant. I don't care about that. I love how you give your training away to people who respond in chat. Absolutely. Absolutely. I'll answer the question, guys. Honestly, like, yes, we have, I have certain ways where I will monetize certain bits, and I have to do that so that this can be a self-fulfilling, self-sustaining endeavor. Because I'm a businessman at the end of the day. Like, these endeavors have to sustain themselves. I can't keep funding my YouTube channel from my other businesses, right? It just doesn't work like that. I can't do that forever. So this has got to take care of itself. Sherlock, thank you for becoming a member. Really appreciate that, guys. You guys don't have to do that at all, but I do. That does help. So I appreciate you guys. Sherlock. Half the channels are full of bots. Don't become like crypto banter when your channel grows. No. And the integrity is going to be the same. Like, people will have their narratives on what they think you are or what you do. But the reality is I'm always going to be the same person, right? Like, I've turned out many different ways of building crazy wealth, which you guys can't imagine, just based on ethics and principles. Like, you guys know I don't short. Something as simple as that. I don't short. I don't leverage trade. And I know exactly how to do it, guys. Like, if anybody knows exactly how to do it, it's me. Right? Like, I could, but it's unethical for me. I don't want to build my wealth on pushing another project to zero. It just doesn't make sense for me. That's how I sit. And I can make money shorting. I will show you guys chart patterns. If you want to do it, that's your prerogative, right? But I personally don't short, because I think it was Gary Vaynerchuk who says, don't have the biggest skyscraper in town by knocking everybody else's down, right? Build the biggest one yourself and lift everybody else up with you. That's important to me. Right, let's refresh this, guys, instead of me waffling. Right. Let me know if you guys can hear in the comments.
And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. The committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions, but such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you could walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see. and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Tamaros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And to try to predict what the appropriate monetary policy response would be. I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Hi, Jerome. Thanks for taking our question. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policy making, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have two questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line?
Here's the question.
Contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the.
He said growth will slow down.
2021.
Making excuses.
You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack, so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on the path to 2%, ultimately get there.
The question is whether you see a recession coming in.
Nice.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
He's just sidestepping the question.
Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So
he said we don't think we have to. Very interesting.
We continue to think that there's a path to that. We know that the path has clearly narrowed.
Interesting.
Really based on events that are outside of our control, and it may narrow further. I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP
Great question.
affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So, I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now.
Very interesting.
Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt.
He's softening the blow.
We'll be looking at.
He's softening the blow. He's definitely seen it. Of course he's seen it.
Hi, Jerome. Victoria Unit, Portico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules anyway.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just I think we've really created a very strong and robust set of rules that will support public trust in the institution, and again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katarina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for making the decision on how much to raise rates, and just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
Good question.
So
It's the bit we need.
I'm going to take that as a question about the next meeting and thereafter. So,
Yes.
As I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases, and now we're getting closer to where we need to be. So that's how we're thinking about it. And in terms of September, we're going to watch the data and the evolving outlook very carefully, and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be.
Come on, Jerome.
But
Just a little nugget.
We might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get. at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber, Associated Press. I wanted to ask about, right now there's a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We're given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times, and it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is that we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because we do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Hi, thank you, Chairman. Nicole Dukine, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for insurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So, executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and that there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment. So I think we're going to be looking at inflation as well. As I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. And we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding recession. So how close are we to a recession? And then how to forecast the possible recessions from banks and economists? How does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was the
forecast? How do bank forecasts the possible recessions? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for
This is important.
months now, and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to full strength, and the markets seem to have accepted it. By all assessments, the market should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So, and I guess your second question was getting the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we'd like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. And we're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell.
Come on, guys, wrap it up.
I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place, got forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that is materially changed the situation, but I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately the situation evolved in a highly unexpected way for all of us, And maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all of this? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time, and so that's really what accounts for the pace at which we moved. And we did when inflation changed direction really in October. We've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month, and we kind of thought we had the story, probably had the story right. But then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted, and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much, Simon Rabinovich with The Economist. You said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is there's, it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is, as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because that's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for the negative slack we have in the economy by the overtight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, I hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
All I've really said is I don't think it's likely that the U.S. economy is in a recession now. And
He said it again. He doubled down.
It's because you do see a very strong labor market, and I think the public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging, and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
There are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been able to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have from a financial stability standpoint, you have a pretty decent picture. Now, There are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that in many cases their paycheck doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape? Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to. We don't want this to be bigger than it needs to be. But ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
Oh man, nearly fell asleep there, guys. Let's switch him off there. Hopefully, let me just make sure the volume. Give me a nudge in the comments if the volume's alright, guys. I'm just gonna notch it back down after their stream was so quiet. Sorry about that. Are we good? Give me a yes in the comments, somebody. Can everybody hear me clearly? Somebody give me a quick yes in the comments if you can hear me clearly. Cool. So, as we can see, interesting bunch of sidestepping from Jerome Powell. Not surprised. He is the market pumper. We need to change his name. He's the dumper pumper. That's what he is, right? He dodges the questions. And he just says whatever's going to pump the market. He's got such a good track record over the last set of FOMC meetings that I think he just wants to be popular. I think he just wants the markets to be his friend, and he's not willing to pull the Band-Aid off. But guess what? The market is like a kid, right, who gets candy every single time. But when you're a kid and you get candy every single time, sometimes you just want to be disciplined by your parents. You're like, why do my parents not love me? Like, do they not care about me? Why are they not doing what's right for me? Right? Jerome Powell needs to sort this out. This is getting beyond absurd here. So loads of things to cover off there. I'm going to make a summary video after this, guys, which you can watch in ×2 speed, just to summarize everything, because there was quite a lot that he said. I'll keep it short, like a kind of 7-8 minute video, which you guys can watch in 4 minutes on ×2, just to hit off all the key pertinent points. But in essence, we're seeing Bitcoin start to move now. I'll cover off the Bitcoin chart in that video as well. Bitcoin's now sitting at 23,000 and it's moving. It's moving as we speak right there. And it's going to come back to that higher high, guys. I'm going to tell you right now, to keep things short, if we break that 24 level and get a daily close above 24, we're back in the game of a relief rally and we'll take it, right? Because if the market is seeing an opportunity here where Jerome Powell is being soft and he's tiptoeing around, they're going to take the opportunity to run. Now, the only caveat, very, very important, is you got this GDP figure coming out tomorrow. He was a bit coy about it. I mean, obviously, they're now debating what is the definition of this recession, which is just absurd. Like, this was never in debate before, but suddenly a couple of days before the GDP figure, the White House come out and say, oh, we're changing what the technical definition is of a recession. Jerome Powell didn't even want to comment on it, and he's the chairman of the Fed. So loads to digest here. The markets are moving because Jerome Powell is not giving them a good spanking, right? Jerome Powell is not giving them what they need. He's not telling them off, which is a little bit of worry. So yeah, loads to cover off there. I'll do a summary video. Thank you guys for joining this live stream. Do stay tuned. I'll upload that within the next kind of 20-30 minutes. Keep the notifications on, and I'll summarize everything there. Thanks for watching, guys, and I'll see you in the next one.